Imagine this for a moment. You wake up one morning in early 2026, you look at your bank account, and you see the same number that has been staring back at you for months. Nothing moves, nothing grows, nothing changes. And you begin to wonder why everyone online seems to be investing, building wealth, talking about passive income, compounding, long-term strategies. Yet your money feels stuck in place like it's trapped under a heavy rock. Now picture a different scene. Imagine you had started investing just 2 years earlier, not in a random way, not guessing, not hoping, but by following a simple and extremely smart order of steps that made every dollar work like a tiny soldier fighting for you day and night. The difference between those two versions of you isn't luck, it isn't talent, it isn't intelligence, it's just sequence. The right sequence turns confusion into clarity, the wrong one keeps you broke without even realizing it. And today, I'm going to walk you through that exact sequence, the one that actually makes sense, the one that prevents you from losing money without noticing, and the one that sets you up to invest in 2026 smarter than 95% of people around you. There are actually 20 easy-to-follow steps that will help you to invest your money in the right way, especially with step 16. Step 1. Build your foundation. With a real safety net. Before you even think about opening an investing app, the first step is building something most people in 2026 still avoid because it feels boring. But this one is the difference between investing with confidence and investing with panic. You need what I like to call your financial oxygen mask. This is your emergency fund, but not the vague version people talk about. This is your personal financial seatbelt that allows you to start investing without constantly worrying that one unexpected problem will destroy everything you're building. Most Americans still have dangerously low savings, and many are just one bad moment away from sliding backward financially. And the truth is, you cannot invest well when you are scared. When life surprises you, a broken phone, a dentist bill, a car repair, you'll feel forced to sell investments at the worst possible time unless you have a real safety net. That's why the smart way to invest in 2026 starts here. So, how much? First, aim for your first $1,000 as fast as possible. This number sounds small, but it stops 80% of life's mini emergencies from turning into disasters. Then build it to 1 full month of expenses. After that, slowly push it to 3 months, a level that creates real emotional calm. When you have this foundation, suddenly investing doesn't feel scary anymore. It feels controlled, it feels strategic, and most importantly, it feels sustainable. Step 2. Eliminate high-interest debt. Before it eliminates you, here's something most people don't want to hear when they're excited to invest. If you're carrying high-interest debt, especially anything above 8%, your money isn't working for you. It's working for the lender, and they love that. They love it because your debt is compounding against you faster than almost anything you can reasonably earn in the market. Think of it like trying to fill a bucket that has holes drilled into the bottom. You can pour water in all day long, but the level never rises. That's exactly what happens when you try to invest, while owing money at 18% or 22% interest. Every dollar you invest is being quietly eaten by a monster in the background. And this monster does not sleep. So the smartest investors in 2026 do something extremely simple, but incredibly powerful. They destroy high-interest debt first. List every debt, list every rate, and attack the highest one with everything you can spare. This is not about motivation. This is about pure math. Paying off a 22% credit card debt gives you a guaranteed 22% return, something even the greatest investors in the world can't consistently achieve. Pay the minimum on everything else, and laser focus all extra money on the highest interest item. Once those toxic debts are gone, suddenly your investing power multiplies. Like it will multiply once you open your YouTube channel, since YouTube is literally on easy mode now, and it's blowing up every small channel that does things right as I teach you in my free Telegram community with the link below. Step 3. Capture every dollar of employer match while you can. Now here's where things get interesting. There is one exception to the pay debt first rule, and it's so powerful that skipping it is like refusing free money. If your employer offers a retirement match, you must grab every dollar of it. This is the closest thing to guaranteed doubled money you will ever get in your life. If you invest $100 and your employer adds $100, you just got a 100% instant return before the market even moves. In 2026, many companies continue offering 401k or similar matches, but millions of employees still leave this money untouched simply because they don't understand what it really is. This isn't a bonus, this isn't a gift. This is a once-per-year opportunity to multiply your contributions. You only need to contribute enough to receive the full match. Not a dollar more at this stage. After you do that, return to eliminating high-interest debt until it's gone. This way you maximize free returns without letting debt keep draining your financial growth. The smartest investors don't chase trends. They capture guaranteed wins first. And an employer match is one of the biggest guaranteed wins you will ever get. And we will go even deeper on that topic in Step 11. Step 4. Open and max out your IRA for 2026. Now you've built your safety net, freed yourself from financial quicksand, and captured all free employer money available to you. The next smart step is gaining control, real control, over your investments. Employer plans often limit your choices and sometimes charge high fees. That's why opening an IRA becomes the next strategic move. In 2026, contribution limits are expected to allow you to put thousands into an IRA. And unlike many employer plans, here you can pick low-cost index funds or ETFs with tiny fees. The money you invest here grows quietly, efficiently, almost invisibly. Most people skip this step, not realizing they're leaving thousands of dollars of potential lifelong growth on the table. The key decision inside your IRA is choosing between traditional and Roth. If you expect your income to rise in the future, the Roth may give you tax-free withdrawals later. If you want a tax break now, traditional may fit better. But the smartest move for many investors in 2026 is splitting contributions, creating flexibility for your future self. As long as you keep fees low and contributions consistent, this step becomes the engine powering your long-term wealth. Step 5. Use an HSA as a secret wealth tool. Most people in 2026 still don't understand how powerful an HSA truly is. It's not just a health account. It's one of the most flexible and tax-efficient investing tools you will ever see. And yet millions ignore it simply because they don't know how it works. If you qualify through a high-deductible health plan, an HSA gives you 3 major benefits. Your contributions are tax-deductible, your investments grow tax-free, and withdrawals for medical expenses are also tax-free. No other account gives you all 3. That's why smart investors treat their HSA like a stealth retirement account. Here's the strategy. Pay for current medical costs out of pocket if you can, save your receipts, and let your HSA investments grow untouched for years. Later, you can reimburse yourself tax-free whenever you wish, even decades later, or use the money in retirement when medical expenses naturally rise. This step is not glamorous, but it is incredibly powerful. Step 6. Boost your 401k beyond the match. Once debt is gone. After your HSA is funded and your other accounts are set up, the next move is to go back to your employer plan and increase your contributions beyond the match. This is the moment where your investing strategy begins to shift from building a foundation to building serious long-term wealth. In 2026, contribution limits continue to rise, giving you more room to shelter your money from taxes. And don't underestimate how powerful tax-protected compounding becomes over time. Every dollar you keep away from unnecessary taxes is a dollar that continues working for you every single year. You don't need to max it out immediately unless you can afford to. But increasing contributions slowly, 1% this month, another 1% next year, transforms your future without putting painful pressure on your present. Most people never do this. They stop at the match, thinking they've done enough. But the ones who reach financial freedom earlier often do so because they kept increasing their contributions while everyone else stayed comfortable, and they increased their contribution thanks to their YouTube channel. Because they invested every dollar they earned with YouTube, and you can do it too with the link below. Step 7. Prepare for taxable investing, the smart way. Now we reach the point where most people mistakenly start, but where you finally arrive fully prepared. The taxable brokerage account. This is where you gain full freedom to invest in index funds, ETFs, individual stocks, REITs, or even other asset classes. There are no contribution limits, no withdrawal penalties, and complete flexibility. But there is also something most beginners never think about: taxes. The smartest investors in 2026 understand that taxable investing requires strategy. You must think about tax-efficient funds, long-term capital gains, and avoiding unnecessary trades that trigger taxes. The goal is not to avoid making money. The goal is to avoid losing money to poor planning. By the time you reach this step, you are no longer guessing. You are no longer reacting. You have a safety net, no high-interest debt, free employer money, low-fee IRAs, a stealth HSA, an optimized 401k, and now finally a flexible account for all the opportunities life will offer you. This is the moment where true investing begins. Not with excitement, but with clarity. Step 8. Understand the true difference between saving and investing before you make a single move. At this point in your journey, something important begins to happen. You start realizing that money isn't just something you earn and spend. Money is something that behaves differently depending on where you put it. And the difference between saving and investing is one of the first distinctions smart investors in 2026 fully understand. Because even though people talk about these words as if they're interchangeable, they are far from the same thing, and confusing them is one of the easiest ways to derail your entire financial plan without even noticing. Saving is about protection. Investing is about growth. Saving is the quiet, stable, predictable part of your financial life. Investing is the dynamic, unpredictable, yet incredibly rewarding side of it. Savings for today. Investing is for tomorrow. And when you confuse the two, you either take too much risk with money that needs to stay safe, or you avoid risk with money that should be growing for your future. The smartest way to invest in 2026 begins with drawing a clear line between those two missions. When your car breaks down, when your rent increases, when a sudden bill appears, that is the moment you'll regret investing money you should have kept accessible. But when you let thousands of dollars sit untouched in a basic savings account for years, earning almost nothing, that is when you'll regret not investing what could have been multiplying. So here's the simplest way to think about it. Money you need soon has to be saved. Money you don't need soon can be invested. And once you make peace with that, your decisions become clearer, calmer, and far more logical. You no longer treat all your money the same way. You treat it according to its purpose. And that clarity becomes one of your greatest strengths as you keep building, like what we will see in Step 14. Step 9. Build your strategy before you build your portfolio. One of the biggest mistakes new investors still make in 2026 is that they start by picking investments instead of picking a strategy. They open an app, scroll through lists of funds, stocks, and trending assets, and they just choose whatever looks interesting. But interest is not a strategy. Excitement is not a strategy. Recommendations from friends are not a strategy. And without a strategy, even good investments can turn into bad decisions, simply because the investor doesn't know what role they were supposed to play in the first place. Smart investing begins with intention. Before you choose your first ETF, before you pick your first stock, you decide what kind of investor you want to be. You decide how long you plan to invest for. You decide how much volatility you can handle. You decide whether you're building wealth slowly, aggressively, or somewhere in the middle. And you decide how much you're willing to contribute every month, even during the hard months, especially during the hard months. Your strategy becomes the blueprint that dictates every future choice. Once you know your timeline, your risk tolerance, your monthly contribution, and your asset mix, picking investments becomes extremely simple. Almost quiet, almost boring. And that's exactly the point. When your strategy is strong, your portfolio becomes effortless. You aren't chasing trends. You aren't reacting emotionally. You aren't guessing whether something fits your plan. You already know. And that is how people who look calm and collected during market chaos are able to stay consistent while everyone else panics. They're not brave, they're not lucky. They're simply following a strategy instead of following their feelings. Step 10. Define risk based on what you can sleep. Through risk is one of those words that makes people immediately uncomfortable because they picture danger, loss, uncertainty. All the things humans naturally want to avoid. But risk in the world of investing isn't about danger. It's about movement. It's about how much an investment's value changes over time. Stocks move more, bonds move less, real estate moves differently, cash doesn't move at all, And understanding risk means understanding how these movements interact with your emotions, your timeline, and your goals. The smartest way to evaluate risk in 2026 is not through complicated charts or mathematical formulas. It's through something much simpler: your sleep. If you can sleep peacefully while holding an investment, that means the risk fits your emotional capacity. If you lie awake thinking about the next price movement, that investment is too risky for you, even if someone else says it isn't. This is why risk tolerance is deeply personal. Two people can hold the same exact investment and experience it differently. One sees volatility as opportunity, the other sees it as disaster. And neither person is wrong. They just have different levels of comfort. When you invest beyond your comfort zone, you will eventually make emotional decisions. You will panic, you will sell at the wrong time, and you will blame the market for something that was actually your strategy's fault. So define risk in a realistic, human way. Ask yourself what level of fluctuation you can genuinely endure. Ask yourself how much time you have before you need the money. Ask yourself whether a deep temporary drop would break your confidence. Once you answer those questions honestly, your portfolio begins to feel like it belongs to you, not to someone else's expectations, and investing stops feeling like stress and starts feeling like clarity. Step 11. Automate everything. So, your system works, even when you don't think about it. There is a secret in the world of investing that most people overlook, not because it's hidden, but because it's so simple that they assume it can't be as powerful as it truly is. That secret is automation. Automation is the engine that transforms inconsistent savers into long-term investors. It removes guesswork, it removes hesitation, and most importantly, it removes emotion, the very thing that ruins more investing plans than bad choices, bad timing, or bad markets combined. When you automate your contributions, you build wealth without having to motivate yourself every month. Your future becomes a habit, not a decision. You contribute automatically, even on days when you aren't thinking about investing, even on days when the news scares you, even on days when the market drops and most people freeze. Your contributions happen like clockwork, and that consistency builds a portfolio brick by brick while requiring almost no ongoing effort from you. Automation also helps you survive the emotional waves that destroy most investors. When prices rise, you contribute. When prices fall, you contribute. When the world feels uncertain, you contribute. And because you contribute on a schedule instead of reacting to your feelings, you constantly buy shares at different prices, naturally averaging your cost over time. This is where wealth building becomes surprisingly peaceful. Your system continues working while you go about your life. You don't wake up every day asking what to do with your money. You already decided. And that decision continues serving you in the background, quietly building what will one day become one of the greatest assets of your life. You can also automate your YouTube channel with AI and with my help. Step 12. Use dollar cost averaging to turn market volatility into an advantage. Most people fear volatility. When the market drops, they feel nervous. When it rises, they feel greedy. Their emotions swing with every movement, and those emotional swings lead to impulsive decisions that harm their long-term progress. But the smartest investors in 2026 aren't trying to avoid volatility. They're using it. They are turning unpredictable price changes into a long-term advantage through a simple strategy called dollar cost averaging. Dollar cost averaging means investing the same amount of money at regular intervals, no matter what the market is doing. You don't wait for the perfect moment, because the perfect moment is something even professionals rarely catch. Instead, you contribute consistently, and the magic happens naturally. When prices fall, you buy more shares for the same amount of money. When prices rise, you buy fewer. Over time, this smooths out your cost and reduces the impact of short-term fluctuations. This strategy removes the pressure of predicting anything. You don't have to know what the market will do next. You don't have to react to every headline. You don't have to time your buys around world events. You simply stay consistent. And this discipline is what turns ordinary investors into extraordinary ones. Dollar cost averaging trains your mind to remain calm in moments when most people panic. You start seeing market dips as opportunities instead of threats. You start seeing long-term growth instead of short-term noise. And without even realizing it, you begin building a position that becomes stronger, steadier, and more profitable as the years pass. That is the beauty of this strategy. It allows you to win slowly, quietly, and consistently. Step 13. Create a portfolio that balances growth with stability. Now that you're contributing consistently and using volatility to your advantage, you're ready to build something most people attempt too early: a well-structured investment portfolio. But unlike beginners who select random investments based on excitement or trends, you create your portfolio intentionally based on a balance of growth and stability. Growth assets, like stocks, ETFs, and index funds, give your portfolio its long-term power. They rise and fall dramatically at times, but over long stretches they tend to grow significantly. Stability assets, like bonds or bond funds, reduce volatility. They move more gently, offering support when growth assets go through rough periods. In 2026, many investors choose one extreme. Either they go fully into high-growth assets and then panic during downturns, or they avoid growth entirely and watch their money grow slower than inflation. But the smartest investors find a blend that matches their timeline and emotional tolerance. A younger investor might lean heavily into growth because time is on their side. Someone closer to retirement might prefer a more balanced mix. What matters most is that your portfolio reflects you, your goals, your comfort level, your horizon. When your mix is correct, the market can shift dramatically without shifting your confidence. You know what you own, you know why you own it, and you know how it serves your long-term plan. Keep in mind that for Step 19. Step 14. Rebalance your portfolio so it stays on course, no matter how the market moves. Once you build your portfolio, a new challenge appears, not in the form of a crisis, but in the form of natural drift. As markets move, your investments grow at different rates. Stocks may surge, making them a larger percentage of your portfolio than intended. Bonds may rise or fall more slowly, shrinking their share. Slowly, without any fault on your part, your portfolio moves away from your original plan. That's where rebalancing becomes essential. Rebalancing means adjusting your portfolio back to its original mix. If stocks grow too much, you trim them and shift money into bonds. If bonds grow too much, you trim them and shift money into stocks. You are not reacting emotionally. You are simply restoring balance. Rebalancing also forces you to do something incredibly wise, something many investors struggle with: selling high and buying low. When one part of your portfolio becomes overweight, it's because it performed well. When another part becomes underweight, it's because it didn't. Rebalancing takes advantage of these natural movements in a disciplined way. You don't need to rebalance every week or every month. Once or twice a year is enough. But that small act keeps your risk level stable, your emotions controlled, and your strategy intact. Rebalancing transforms your portfolio from something the market controls into something you control. And that control is one of the final steps toward becoming a truly smart investor. Step 15. Protect your wealth with proper diversification. Instead of blind optimism, once you have a functioning portfolio and you've learned to rebalance it, you reach a moment where many investors in 2026 make their biggest mistake. They start believing that because things are going well, nothing can go wrong. And when people begin to feel invincible, they begin to over-concentrate their money into one single area. Maybe a single stock they love, maybe one industry they feel confident about, or worse, one trend that looks unstoppable. Overconfidence is the silent assassin of investing, and it takes down people who otherwise did everything right. Diversification isn't about being scared, it's about being realistic. It's an acknowledgement that even the best investments can have a bad year, the strongest industry can fall out of favour, and the most popular trend can dry up faster than anyone expects. Diversification protects you from the unexpected, while still allowing growth. It's not about spreading yourself thin, it's about building a structure that doesn't collapse when one pillar shakes. Think of your portfolio as a table. If it has only one leg, the slightest movement can send everything crashing. But if it has many legs, growth stocks, international funds, bonds, real estate exposure, maybe a little cash buffer, the table becomes sturdy, balanced, and far less likely to topple. The smartest investors diversify not because they lack confidence, but because they understand that confidence and caution can coexist. And when those two forces work together, your wealth becomes far more durable than anything you build on optimism alone. Step 16. Strengthen your mindset, so you don't ruin your own progress. Investing isn't just numbers. It isn't just charts, contributions, or rebalancing strategies. Investing is emotional. It forces you to face fear, greed, impatience, doubt, and sometimes even boredom. And if you don't strengthen your mindset, these emotions will undermine your progress without you realizing it. People in 2026 still fall victim to the same psychological traps that captured investors decades ago. Markets drop and they panic sell. Markets rise and they chase trends. They compare themselves to others, feel behind, and start making rushed decisions. The smartest investors understand that the real battle is internal. You can set up the perfect portfolio, automate everything, diversify wisely, and rebalance with discipline. But none of that matters if you let fear or excitement push you into impulsive moves. Your mindset is the final barrier protecting your plan. You have to train yourself to think long-term, even when the short-term tries to demand your attention. You must learn to ignore noise, ignore predictions, ignore dramatic headlines, and focus on the one truth that actually matters. Wealth grows through consistency and patience, not through reacting to temporary chaos. When you strengthen your mindset, you stop worrying about every fluctuation. You stop questioning your decisions every day. You stop chasing shortcuts. And slowly, investing becomes peaceful. It becomes intentional. It becomes something you control, instead of something that controls your emotions. That mental stability becomes more valuable than any stock pick, any strategy, or any trend you might follow. It becomes the quiet force that carries you through the years, allowing your wealth to build without constant interruption. Step 17. Increase your contributions. Gradually as your income grows. As you continue building wealth, something subtle but incredibly powerful begins to happen. Your income grows, maybe slowly, maybe unpredictably, maybe in sudden jumps, but it grows all the same. And most people, without noticing, let their expenses grow at the same pace. This is lifestyle creep, and it quietly steals opportunities from even the smartest investors. But if you want to truly invest wisely in 2026 and beyond, you turn growing income into growing contributions. Every time you earn a raise, or receive a bonus, or expand your business, you redirect a portion of that increase into your investment accounts. It doesn't have to be dramatic. Even adding 1% more per year transforms your long-term results. The key is building the habit of increasing contributions before increasing your lifestyle. This approach ensures that your future grows faster than your spending. It ensures that you maintain a comfortable life while still pushing your financial destiny forward. And most importantly, it leverages the reality that you are not investing with static numbers. You are investing with a life that evolves. This step is where wealth builders separate themselves from everyone else. They don't settle at contributing the minimum. They don't freeze their plan in place forever. They evolve it. They expand it. They allow their success to feed their future. Every year you increase your contributions, even a little. You accelerate your timeline. You shorten the distance between where you are and where you want to be. And over decades, those small increases become monumental. They become the reason your portfolio grows faster than your salary, faster than inflation, faster than your expectations. This is the quiet accelerator that most people overlook, but the smartest investors embrace fully. And you can also increase your contribution by opening your YouTube channel, since YouTube is on easy mode now, and you can also start now to increase your investments, thanks to it, and to my help. Step 18. Avoid unnecessary complexity and stick to what works long term. Once people start feeling confident in their investing abilities, a new temptation emerges, the temptation to complicate everything. They start adding dozens of funds, swapping strategies frequently, chasing every new financial invention, and layering unnecessary complexity on top of an already functional plan. Complexity feels advanced, complexity feels intelligent, but in reality, complexity often destroys clarity, reduces discipline, and creates a maze you didn't need to walk into. Smart investors know that simple is sustainable, and sustainable is profitable. The most successful portfolios in history weren't built on hyper-complicated systems. They were built on long-term discipline, consistent contributions, and a small set of diversified investments. Index funds, bonds, a little real estate exposure, automated contributions, regular rebalancing, a clear structure, simplicity. When you keep your investing simple, you make fewer mistakes. You spend less time managing things that don't matter. You avoid emotional decisions. You keep your strategy clean and predictable. And you free your mind from constant decision fatigue. Simplicity doesn't make you less sophisticated. Simplicity makes you effective. And effectiveness is what builds wealth, not complexity. Avoid the pressure to look smart. Focus on being smart. And the smartest thing you can do is maintain a strategy that you can follow for decades without burnout, confusion, or unnecessary risk. Step 19. Stay educated without letting information. Overwhelm you information in 2026 is everywhere. Every platform, every app, every video, every article tries to tell you what to do with your money. Some advice is great, some is terrible. Most is loud. And if you try to absorb all of it, your mind will fill with contradictions and your strategy will crumble under the weight of constant uncertainty. This is why the smartest investors learn selectively, not endlessly. They choose a few trusted sources. They study principles, not predictions. They learn the fundamentals deeply instead of chasing new tricks shallowly. And they remind themselves constantly that knowledge is only useful when it guides your plan, not when it overwhelms it. Staying educated means refining your mindset, reassessing your goals, and adapting your strategy only when it genuinely improves your future. It doesn't mean jumping from idea to idea because something sounds exciting. It doesn't mean abandoning long-term methods for short-term guesses. And it definitely doesn't mean believing that more information makes you a better investor. Better investors are made from clarity, not from noise. Use information as a tool, not as a distraction. Learn enough to remain confident. Learn enough to stay curious. But never let learning turn into chaos. The smartest investors grow in knowledge the same way they grow in wealth. Slowly, steadily, intentionally. Step 20. Stay consistent, long enough for your future to fully unfold. This final step is the one most people underestimate. They think the secret to investing is picking the right stocks, timing the right moments, finding the perfect strategy. But the real secret is consistency. Boring, unwavering, unstoppable consistency. The kind of consistency that lasts not for months, not for years, but for decades. The kind of consistency that sees markets rise, fall, crash, recover, stumble, and surge again, without letting you lose sight of your destination. Consistency is the great equalizer. It empowers average people to build above-average wealth. It gives time enough space to work its magic. It allows compounding to unfold fully instead of being interrupted repeatedly. And it transforms investing from a stressful guessing game into a smooth, predictable journey. Consistency is not glamorous. It doesn't make headlines, but it builds results that headlines are made about. Every long-term success story in investing is built on this one principle. The person stayed in the game long enough for the game to reward them. And that is what you must do too. Continue your contributions. Continue your discipline. Continue your strategy. Continue your patience. And you will watch your future unfold in a way that feels almost inevitable. Because once consistency takes over, the outcomes follow naturally. If you follow these 20 steps in the order they were meant to be followed, investing in 2026 no longer feels like a gamble or a mystery. It becomes a structured, confident process where every action has a purpose and every choice brings you closer to the life you're trying to build. You're no longer reacting to the market. You're guiding your future with clarity and intention. And the best part is that you don't need perfect timing, special knowledge, or extraordinary luck. You only need direction, structure, discipline, and time. When those four elements combine, your money stops standing still and begins transforming into something powerful, something that grows quietly, steadily, and endlessly as long as you stay consistent. Your future is no longer an accident. It becomes a plan you chose to build. I want to leave you with a question. If you've made it this far in the video, it means what I'm explaining to you in my free Telegram community works, right? So join with the link below and let me know in the comments your thoughts about that. Subscribe to this channel. And if you want to go deeper in these financial topics, you have a full guidance in the video that will appear on your screen in the next few seconds. And I'll see you soon. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.